A very warm welcome to everyone joining us today. I'm Smriti Chhajer, your host for the third edition of SSW Navigator, an exclusive investor education initiative by SubhShanti Wealth. Education has always been central to our core mission, and in our endeavor to reach as many people as possible, be it a client, an investor, or simply someone eager to learn, we created this webinar series to connect you with industry experts and their insights on various important topics. In today's session, we are looking beyond our borders. We will be discussing global investing. We have with us Mr. Hari Shyamsunder, VP and Institutional Portfolio Manager at Franklin Templeton Asset Management. He is a seasoned professional who joined the investment management industry in 2009. Over more than a decade, he has worked alongside Franklin Templeton India's equity fund management team and has also served as the CEO of Navi AMC. He is also a CFA charter holder. Joining him is Mr. Sandeep Chhajer, founder and CEO of SubhShanti Wealth, who has spent more than 2 decades in the financial markets. Now, before I hand over the spotlight to Hari, I would request Sandeep to set the context for our discussion today on these exciting global mega trends. Over to you, Sandeep.
Thank you, Smriti. Good morning, everyone, and thank you for being here. Something strange is happening in the global markets right now, and I think is the most important conversation we have had together in years. 3 weeks ago, on the 28th of April, OpenAI's own CFO warned her team that the company was spending too much on data centers relative to its revenue. The next day, every major AI infrastructure stock in the world traded lower. Shortly after, Microsoft quietly stepped back from being OpenAI's sole compute provider. And yet, combined hyperscalers capex for 2026 is now guided at $723 billion, up 77% from last year. Let's turn to defense now. The Trump administration is actively pushing a Ukraine settlement. Peace negotiations are happening in Doha that would have been unthinkable 2 years ago. And internationally, defense stocks are at all time highs. Rheinmetall, a German tank maker, almost no one tracked 5 years ago, has multiplied many times over. Lockheed, RTX, BAE, all are at record heights. Asian defense spending is rising, and India's own defense story is producing some of the strongest small cap performers in our own market. Peace is being negotiated, defense is being priced for war. For an Indian investor sitting in 2026, the question is no longer should I go global? It's how do I think in a world where every consensus narrative seems to change 6 months? That's what we are going to talk today. With me is Mr. Hari Shyamsunder, one of the sharpest voice on these themes. Over the next 45 minutes, we are going to make sense of it. Let's get started. Over to you, Hari, and thanks for coming.
Yeah, I hope it's audible now.
Yeah,
So,
perfect. Yeah.
thank you, Sandeep, for setting that context, and good morning to all the participants here. It is a very, very topical subject indeed. This is a time which we are in where the world has been going through its own shares of turmoil, but at the same time, we seem to be in some kind of a global bull market at the same time. And how do some of these things reconcile? Sandeep spoke about defense spends being at all time high, which points to a lot of geopolitical turbulence. But at the same time, we are seeing AI spends going through the roof, and that is driving stock market. So, are these two, I think the question gets asked about what really drives global investing, and what really determines winners and losers. Why is it important really to have a global exposure? Why is it important over a longer period of time? So when we are talking about long-term investing, when we are talking about setting goals for ourselves, we are not talking about the next 1-2 years. We are talking about um, many years. You're talking about decades, and many things change in these periods of time. So I want to set a bigger context here, and in fact look at a 125-year kind of a history. Let's look at, just to start off, to give a sense of global investing. On the left hand side here, you have the end of the 1900s, almost at the start of the 1900s, and at that point of time, I'll just point out one or two countries here. We had Austria, which is the sixth largest stock market in the world. And by 2026, after 98 years of not having its own, or 98 years of having not reaching its previous highs, it ends up not even barely being in this on the right hand side chart. On the other hand, a US investor, 14.5% of the world in the start of 1900s, is now at about 61 or 62%. Um, and this is just two static points, but if you look at how it has changed over periods of time, countries come, countries go in terms of what's the hot markets of the period. You have Japan here, for example, in the 80s, expanding to be a very, very sizable part of the world stock market, and since then it has fallen away in terms of the percentages, at least, with USA coming back. If you look at emerging markets, the story is even more volatile, and India definitely is an emerging market. It's a growing emerging market, definitely expanding in its share since the 2000s. China is one of the biggest ones. It's come up in a big way. But you see the other components, like South Africa, which is ZAF here. It was very large at one point of time. It's not so large now. The point is that countries are, we are based out of India. We believe definitely in the India growth story, but there are multiple stories happening in the world at any point of time. So the question is, I think one story which we tell ourselves is that, well, India is the fastest growing GDP. It's the fastest growing economic powerhouse in the world. It's a fastest growing major country in the world. But what we have seen also is that it's not always just about the GDP size. It's about other factors as well. So it is about corporate governance. It's about linking these two factors together. So sometimes it's not just about GDP size, which determines what really drives the stock markets itself. One part, for example, one very important factor is free float. Basically how much stock is available for investors to trade. Um, Typically, developed markets have more of the stock to trade in any particular company. India has maybe about 45 to 50% of any company which is available to trade. So that drives stock markets as well. What we also see is that globally the winners keep on rotating, and a more near-term time frame. So if you look at the more near-term time frame, of course, US is dominated, but there have been a couple of years where in China has done well. There have been a couple of years where US has done well. So I said Europe has done as well, like for example last year. So the winners definitely rotate when you're talking about global diversification, and sticking to any one country means that you are missing out on broader global trends. Even if you look at the world's largest stock markets today, I've spoken about US and China is the next one, but there are a lot of other markets which are doing very, very well. Now, what drives really the growth of these stock markets? And I would argue it is basically the evolution of what's the most important industries of the time. In the 1900s, you look at both US and UK, rails and banks were the biggest markets, were the biggest sectors of that time. Rail was 50%, 50% of the stock market. The rail was literally a lot of what tech today is. It is a function of these two economies and their ability to capture the trends, which is what has meant that the stock markets have done so differently. US has done much better than the UK, of course, during this period of time. And it is a function of being able to capture these trends. Now, every country has its strengths. Every country has its own growth, which is happening. India is on its own growth path. It's leading in consumption. It's growing its manufacturing. It is growing its technology services economy in particular. That's its story. At the same time, there is another story, as you already started off by speaking, which is artificial intelligence. You're talking about global defense spends. These are all different themes which are playing out in different parts of the world simultaneously. And that means that different countries can have different outcomes as well. So it's important to be globally diversified. In the last 1 year, we have global markets have been on a bull market, and different countries have done spectacularly well, and well, India has not done as well. Context here has got to be that many of the markets which are put up here had not done very well for many years, unlike India. So if India has given healthy returns over the last decade, something like a UK had not done anything. Or even markets like a Switzerland had not done really much. Even China was pretty muted. The last year, India was subdued, while the rest of the markets did particularly well. So I think one thing to speak about here in this context really is what is it that's been driving it in the near term. So let's come to the here now. Spoken about already about how on a longer term time frames markets perform differently. And so having a global exposure allows you to participate in themes and trends which are not available in your country, in our country. And I think that is always relevant because these trends will come back and influence our lives. Our day-to-day lives will be influenced by some of these. And that I think it's important to be a part of. Coming to the here and now, in terms of US, we have US markets and even many of the other markets like Korea, Taiwan. One thing has been binding, say, Korea, Taiwan, and even the US markets together, and that is, and even China to some extent, that is the AI bull run. Here we've seen the earnings being very, very strong in the US markets. Multiple ways to look at it. But basically, what you're seeing is that with spends going up dramatically, we have seen that growth has been very, very sharp in some of these markets. Now, I'll pause here and really highlight this particular data, which is what Sandeep has already spoken about. CapEx for the top 5 US hyperscalers is growing more than 70% year on year in 2026. Now, look at the numbers which are there here. We're talking about $725 billion of spend, which has been revised up 35% since the beginning of the year. Let me give you some context here. India's largest company, market cap is currently more than about $200 billion, a bit more than $200 billion. That $200 billion represents the entire worth of it, of all the cash flows over the next future, which is what the market sees today. In contrast, in 1 year, these companies are going to spend more than 3 to 4 times that particular market capitalization. So that's a huge amount of money which is going into spend. This money has a multiplier effect, right? So if they are spending on um, they're spending so much money, it is going into a number of different things. It's going into data centers, no doubt. It's going into creating of chips. It's going into semiconductors. It means that this money starts multiplying itself across the world. So these companies give it to people looking to set up data centers. They take the money, start spending it for creating the data center, which is brick, mortar, your IT equipment, your power systems. All this money starts spending across the world, and that is what is driving a number of different markets across the world. Um, this is just an example of how large this US construction also is right now. So we are looking at this red line is basically how much money is being spent on data centers every year. What this chart really tells you is that today we are seeing that data centers, there's more money being spent on data centers than, or as much money is being spent on data centers as offices and warehouses, and more than all the money which is being spent on retail, on all the money which is being spent on retail, more than that is being much more than that is being spent on building data centers in US right now. And that says a lot, right? So more than just the money which is being spent on all the shops and establishments there, now we are seeing data center spends being reaching those levels. So it's not a marginal amount of spending anymore. This is front and center core part of capital expenditure which is happening in US. US is one part of the global data center. It's about 45% of the global data center spends or global data center capacities. Um, and but rest of it, there are data centers coming up across the world. India is going to start playing a role in this as well. I want to point that out right now. India today is just 1% of the global data center capacity. In about 3 to 5 years, we could be as much as 5% of the global data center capacity. So we are multiplying our market share in global data centers manyfold. But this is something which also means that, well, India is participating. There's a part of India, at least some companies which are participating in this, but there is a bigger story which is playing elsewhere at the same time. So we can see data center capacity expanding manyfold, maybe tripling, maybe doubling. There are various estimates doing the rounds, but there's a lot of money, therefore, being spent on this particular trend. So the question gets asked. I think one question which keeps on getting asked is, is this a bubble? I think that is one thing which we always ask, right? I mean, is artificial intelligence, there's so much, the stocks are going up very, very fast, a lot of excitement around it. Is it a bubble? And I think the way to think about this really is that um, bubbles happen when you have spent more than money than you have, right? So, but if you look at the spend so far, most of the spend has been out of their own cash flow. So these companies which are spending, when I said that the numbers were jumping by 70%, they're jumping very dramatically. What's useful to note is that this has been entirely out of their cash flow. So it has not yet reached dangerous level of spends by these companies. It's incredible that they've spent so much. There's been so much hype, so much fury about it, but it has not yet reached the stage where they are starting to add debt. They're taking on not yet taking on debt to spend this. So this also means that yes, there's a lot of excitement around it, but it may not yet be the tipping point where these break out. Now, when things grow so fast, there will be pullbacks. There will be volatility which will be there in the markets at any point of time. But at the same time, it also means that this is a very powerful trend which has still got legs to go. So I do not want us to go away with this saying, well, the stocks have done well. Too bad we missed out on it. I think the broader message is that we need to get onto these emerging themes and at some point of time or the other, right? So if 5 years back, you would have said that, well, global stock markets have done well already. Social media, the trends have done very well, so there's not much to be gained from here. But what happens is that some of these countries are now at the cutting edge of some of these developments. So, to a certain extent, sitting here, I will be the first to say that we don't know where this can lead to in terms of the innovations which can happen as a result of this new technology which is playing out. So I'll just say that don't trying to double guess where this can go. I think is the perfect recipe to hold ourselves back, to get paralyzed. We think too much and we'll start getting paralyzed by in our actions. It's always better, therefore, to start, to make an effort to get onto some of these themes, to globally diversify and globally start your investment journey as well. History also says that the investment cycle has more room to run. This is just a simple graph saying that where are we into an investment cycle? And if you're looking at this, these are previous capex, these are previous cycles which have happened in terms of similar amount of spending, capital expenditure spending, fixed investment spending, and we are seeing that, well, there is still maybe some room to go in terms of the spending. So, just driving home this point that, well, there's more to go in this particular journey because the growth rate of some of this companies is being very, very sharp. So, an Anthropic, among the fastest growing companies in the history of mankind, as well as is OpenAI. So, well, and so the next question that comes is, well, we know AI is happening. So, what don't we know everything there is to it? And I'll argue that, well, beyond the AI as we know of it today, we have a next phase of AI which is possibly coming, which is physical AI. Essentially, today all the AI is trained on what we know on the internet. Uh, as we go ahead, we are going to move to a new era where there will be humanoid robots. That those humanoid robots will start getting enabled with this artificial intelligence, and that means that there's a lot more spends, lot more investments which are still possibly needed in some of this in these spaces as well. And the funding for robotic companies is very, very strong. The projections for global humanoid sales is looking very, very strong. It could reach 10 million robo sales in the next 10 years. That's the kind of projection which are there. So, just the longer story is that this is again a theme, a tool. Artificial intelligence as a tool is something which we are just starting. The uses of it is unknown. There will be volatility in this journey, uh, but that does not mean that we should not participate. This could be the start of the other analogy is looking back in the 90s when the start of the internet was there and when we had websites coming up. And everybody thought that, well, setting up a website, that's all you need to do in internet. And what else is there to do? There were many people who felt that way. But what we learned is that, well, that was just a starting point, and many more new things happened over the next decade, over the next 20 years, 25 years. Things that we take for granted, like a Blinkit today, would not have been possible 25 years ago, definitely. So the AI as well is something like that, where you definitely don't know what could be possible as well. We have a concern, of course, around AI, which is job security. What's going to happen to jobs? And I think there's some studies that show that about 24% of jobs worldwide are likely to be exposed to Gen AI. I am a techno optimist in on this front. I think that we also don't know the number of jobs which can be created. So I think one thing which we note here is this point: 60% of the jobs in the US that exist today didn't exist about 80, 90 years back, right? So more than half of the jobs today which people do didn't exist in some people's lifetimes. So that I think is the other thing which is underappreciated that we are looking at. So one other example is that when Microsoft Excel came up in the 90s, many people thought that why do we need accountants? Because I can do everything on Excel. I don't need them to use physical paper and pen. I don't need those many accountants, right? So people felt that we will have less number of accountants. But the Excel actually ended up boosting the demand for accountants, and that has meant that there'll be more companies which have come as productivity has improved. So, while yes, there is something to be worried about AI and the employment in the near term, I think that as productivity improves, humans have tended to find ways to utilize this. So I think that is something about artificial intelligence which we need to think about. You know, and finally, I'll just speak about U.S. market valuations. It's of course the largest market, so of course we should speak about that. And any global investing cannot ignore the U.S. markets. Headline valuations are not cheap, but what I'll point out is there's a dispersion between the left-hand side, which is the typical S&P 500, which you look at, versus another one, a special one called the equal weighted. Basically, any index is weighted based on the size of a company. The right hand side says, I don't care about the size of the company. All companies are equal sizes. So if you look at that on that basis, on the right hand side basis, it means that the average company is not very expensive in the US. There are some big companies which have become expensive, but many smaller companies are not that expensive in this market. And I think that means that maybe this market, um, while we are worried, some people will say that, well, oh, it's very, very expensive. There is something to be said about how the broader markets are not very, very expensive in the US market. So that's some context on US itself. I'll switch over to Europe now in the context of what Sandeep has spoken about in terms of defense, and this is really how you can clearly see this is the global military expenditure by region over the last 35 years, 35, 37 years. You can see a phase where post global financial crisis, for almost a decade, there was not really too much increase in the global military spending. It was pretty peaceful in that sense. Even here, well, we had some expenditure. This is all because of, post 9/11, there was a sharp pickup. Pre 9/11, again, a period of not too much pickup. Post 9/11, you had a sharp pickup from about 1.2 trillion to uh, close to 1.8 trillion or so. But then after that, once military operations wound down in Afghanistan, you had a period of um, calm. But post the Russia-Ukraine conflict, you can see clearly a sharp acceleration again in the spends. And now with the US changing its rhetoric, it's starting to say that we do not want to spend as much. We have seen actually, if you look at America's spending over the last 5 years, the spend has not really picked up to the extent. So about a trillion, and that's where it has stayed. Um, this is very interesting. And despite this, we are seeing the global military expenditures expanding very, very sharply. Europe, in particular, has taken up a huge mantle. They've taken up the burden of this. And last in 2024, you see the sharp jump. This was the biggest jump in any year for the last, at least till 1990. So that is the kind of growth which you have seen, and in expended defense expenditure which is happening in the world, and Europe definitely is driving a lot of it. It's growing its expenditure at about 15% a year, and not a very small base. And that is, if you look at the global, which are the biggest countries, about 5 countries represent about 60% of the world spending. US is still the largest, but I will note that this percentage has fallen in the last year. It was about 38% in the previous year. Now it's about 33%, and other countries have started picking it up. Germany, in particular, watch out, it's doubling its expenditure over the next 3 to 5 years. India, not slouching either. It's also growing very rapidly. China and Russia, of course, Russia in the middle of a war, so spending as much as it can. And all of this has meant really that its growth has been very strong for the global defense companies. So these Sandeep spoke about Rheinmetall Defense, a stock which has done very well. Look at the kind of growth rate which is playing out. In the end, stock markets, we still believe, are a slave to earnings. You have strong earnings, the stocks do very well, particularly after if it comes out a period of no growth. So we are looking at the last 5 years for this company. If you go back to the decade before that, there was not much growth. It was low single digit at best. So from there, the companies have started growing at very healthy double digit growth. So this is the second theme definitely which is happening in the world. And coming around the countries to Asia, closer to home, but definitely if you look at the broader Asian markets, there's a more dispersion in terms of the character of the countries. Uh, 4 countries are particularly large: China, including Hong Kong, Taiwan, South Korea, and India. These are the 4 big ones, excluding Japan. Japan is its own story, not really covered it, but there as well. There's a theme playing out there, and the Nikkei has been making new highs on a almost on a daily basis now. Um, but the interesting thing about this particular, when you look at these 4 big countries, is the kind of concentration which we see in the world's largest markets, right? So, India, one of its strengths, which I'll still point out, is that the top 10 stocks are just 34% of the total market index. Um, this is a key strength. It's diversified. It means it's not dependent on any one theme. But Korea and Taiwan, on the other hand, top 10 stocks, 60 to 70%. Just top 3 stocks are 50%, 60% of the indices. And that means that in the current world which we are in, which is AI, it has been a big beneficiary of the artificial intelligence related spends. And this has meant that a few of the Asian companies have become very large in this context. So in Taiwan, you have Taiwan Semiconductor, which is more than 50% of that index, and it actually is the largest company in the emerging market index at about 13 to 14%. So it's among the world's most widely held stocks currently. And if you look at all funds across the world, Taiwan Semiconductor is now among the most widely held stocks in the world. Korea is a similar kind of a case. They're not semiconductors; they're a different part called memory. Two of the companies, Samsung and Hynix, are 50% plus of the index now. It's gone to about 55% now, in fact, for just those two companies. So these three companies, Samsung, Hynix in Korea, and TSMC in Taiwan, are the largest among the largest companies in the emerging markets world as you speak today. Just drilling down to emerging markets itself, and so when we speak about global investing, there are numerous ways in which you can. So I mean, it can get overwhelming. You can say that where do I even start? Um, but there are broad baskets which you can look at. So, for example, you can look at, for example, US is one in itself, which is one large market which can't be ignored. But emerging markets is another grouping which is there, where there's a whole bunch of countries. About 80% though is Asia. But this is one grouping which has been fairly popular in recent times, and more recently, this has not done well over the last decade, emerging markets, but in the last year, driven by the weights of Taiwan and Korea and China, this has done particularly well. Um, and again, the reason why Taiwan, Korea have done well just gets back to artificial intelligence, right? So global hyperscaler spending, how that is translated for some of these other Asian companies, I think is the key driver to note here. One thing which, see, again, the unpredictability of what is playing out in the world, and even in AI, I want to highlight in the next slide, which is that we think that artificial intelligence, Anthropic, OpenAI, these are all American companies. It looks like they have won the race. But what I'll point out is recent trends are showing that even Chinese models, are starting to pick up massively in terms of usage. Um, so the point is that in these kind of emerging global trends, it still is worthwhile being diversified and not saying making fixed bets, saying that this is going to be the winner. And so it's so just to write off, just to decide that OpenAI or Anthropic is going to be the winner is again not the way to go about getting an exposure to some of these new emerging trends. Um, I think one thing to speak about in this particular context really is oil prices, and what happens as a result of the Middle East crisis. There are I think various ways to look at it in terms of global trade and getting worried about what all the noise that is there in the world can feel like it is a bit too much right now. Uh, but I think what it eventually gets down always is about the earnings, and with the kind of spending which we have spoken about already, um, you end up seeing that this still has legs to go. I think that is one of the things that we are seeing. And the question here really is now, what about India? I mean, why is India not doing well? Isn't it really? Is it? Should we just forget about India and um, just look to invest everywhere else because AI is not really a part of the Indian game. I think India is its own story. We have our own growth engine where we have not been participating in the global stock markets recently. I think that is a function of some of our own growth, which of course a lot of it got bunched up through to 2024, and we have had a period of cooling off. But I think the growth engine has been kickstarted again. We are a bit more positive on some of the impact of the growth, and we feel that there are numerous reasons to think about why growth was picking up in January, February before the West Asia crisis hit. On West Asia itself, our conclusion really is that, well, outcome can be messy, but we have buffers. India has entered with low inflation, a good discipline on fiscal deficit, a improved current account deficit because of a booming services trade, and in basically and lower energy intensity. On energy intensity, basically what we're saying is that we are consuming less oil as a percentage of GDP or a percentage of our economy. So every rupee of GDP requires less energy than we required 10 or 20 years back. And that means that even if the prices go up a bit, it's not hitting us as much as it did even 10 years back. So I think that as we get more certainty around energy flows, and we are able to get the oil which we need as the oil starts flowing through the Strait of Hormuz, I think the attention will refocus back on India here. So India is its own story. In the long term, it has created wealth, and we continue to be absolutely positive on the longer term story here. But undoubtedly, will it participate in all of the global trends? No, I don't think that India is going to be participating in the AI infrastructure build out. India is likely to participate in a different part of the AI story, but not necessarily in this phase as we look at it right now. And therefore, but that does not mean the Indian market cannot do well. As I said, it's on its own story. It can continue to do well without participating in some of these trends, but it is good to have a portfolio which does participate in some of the global trends as well. So, just to conclude here, I want to really just summarize the key gist of all that we've spoken. We've spoken about different themes, different trends, different countries, different markets, how markets have evolved over the last 25 years. And what we can conclude from all of this is that clearly the world offers more opportunities than any single market can provide. So if Taiwan is doing well this year because of global semiconductors market, it was not doing very well 2 years back when India on its own global capex cycle was doing very well. So the opportunities which are there in the world are far more than any one single market can provide. Uh, so diversification across countries and global leadership really helps you capture global leadership. Yesterday's winners are not always tomorrow's winners, and this leadership change is something which you should have some exposure to, definitely, particularly if in a globalized world which we live in today, Indians are traveling a lot more internationally, so there is a bit of a dollar exposure which we have. Having a bit of your assets also in the growing parts of that currency will help you meet your needs and goals as well. Today's environment is definitely being shaped by AI, deglobalization, defense, energy transition. Um, but successful investing really is less about finding that next big winner and more about building a portfolio which can participate in many sources of growth. Uh, and I think that is what will keep you interested in your portfolio as well, as long so you don't have the fear of missing out. If your portfolio's got a bit of everything, it participates in those sources of growth. What I want to highlight here also, though, as I conclude, is that it means that your portfolio will always have some parts which are not doing as well as others. So India today is that part of the portfolio. Having global investing 3 years back in your portfolio would have made you question having that itself. This and so to having to India and today in your portfolio means that you're tempted to transfer everything to another one. But diversification is about having participating in all the sources of growth, but also having some parts which are not doing as well as the others. And that's a trade-off which we have got to learn to be as investors as we participate in the trillion-dollar opportunities that global investing offers. With that, I'll stop here.
Thank you, Hari. That was a very valuable session. The physical AI perspective was a real highlight, and the idea of AI transitioning from internet trained models to humanoid models is a frontier most of us are only beginning to grasp. It was fascinating to learn that even something as fundamental as water is now a part of the AI conversation. A small part, like you mentioned, but yet it is. As you also rightly pointed out, successful investing is less about finding the next big winner and more about building a portfolio that can participate in many sources of growth. I am confident we are all leaving today better equipped to translate these shifts into meaningful portfolio opportunities. Now, I urge each one of you to take out one more minute and please share your opinion on today's session. The link for the form is in the chat box. It's a feedback form. Before we sign off, a quick reminder that SSW Navigator is our ongoing commitment to your financial education. New topics, new experts, and new learnings every single time. So please join the SSW Navigator WhatsApp community to stay updated on our upcoming webinars. The link is in the chat box. Please share this with your friends and family and anyone else who you think is inquisitive about the investment world. Thank you for being such an interactive and wonderful audience today. Stay focused, stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.